on the tanker market going forward, we're obviously in a very healthy environment. There is some concern on the build-up of the order book, and as everybody knows, there is a step up in the schedule of deliveries towards the end of next year. But I think if you, pardon me, if you look at the most recent IEA report and compare their demand numbers for the first half of this year to the second half next year, it's a step up of, I think, 2.7 million barrels per day. If that happens, I think we're all fine. Then we can absorb these ships and remain in a healthy freight environment, even with next to no scrapping. So we are, fairly confident that this is going to continue, that we'll be in a rewarding and attractive market environment.
The big change is in the 2016 order book, where Clarksons now expect to see more ships being delivered in 2016, 45, now up from 40, but crucially less scrapping, now 60 LCCs to be scrapped instead of 12, taking net impact for 2016 in VLCCs from net 28 vessels to net 39. On Suezmax, the net effect is to see 3 more deliveries in 2016, all due to less scrapping. This is to be expected given the strength of freight rates as we have seen year to date. Whilst every new order in the shipyard is negative for the market, we still retain the view that the current order book is moderate and manageable given the outlook for industry fundamentals. We see a number of reasons supporting this view. We believe there has been some acceleration in ordering to avoid compliance with Tier 3 legislation that kicks in on the 1st of January 2016. We do not expect many, if any, orders during Q4, given this brought forward demand. Commentators need to remember that with a wasting asset class with an average scrapping age of 20 years, there should always be some attrition in each year of between 4 to 5%. So a 15% order book over a 3-year length is not at all unusual. Closer inspection of the order book from Clarksons also shows that private equity-oriented orders have fallen off. We have not seen an order from this segment for over 15 months now. This reflects one part of our wider thesis that financing of the tanker sector going forward will continue to be challenging and act as a barrier to entry.
We look at our expectations for the upcoming winter market, which we believe will be strong due to both fundamental and seasonal factors. Looking first at the fundamentals, the IEA forecasts global oil demand to increase by around 250,000 barrels per day during the fourth quarter. The increase in demand is largely due to the combination of cold weather in the northern hemisphere and the conclusion of refinery maintenance. While Chinese oil demand softened slightly in the third quarter, imports remain steady at around 6.7 million barrels per day. This suggests that stockpiling programs are providing underlying support to the Asian tanker market as the Chinese government looks to take advantage of low oil prices by adding to its strategic petroleum reserves. In addition, the relaxation of import restrictions for Chinese independent, or what we call teapot refineries, would boost crude imports into China and lead to a diversification of supply sources for Chinese crude imports. Such diversification is positive for crude tanker rates.
We've always recognized at the back end of 16 there was going to be ships coming in from then through 17. But I think on the demand side, we're confident that we don't forecast an OPEC cut in production, and on that basis, lower oil prices remaining low should be good for bolstering demand going forward. So I think our view hasn't changed from the summer. We still think we've got a runway to run here, but our focus is right now making sure that the ships that we are taking care of and that we're assimilating into the program get into this winter market that we think is going to be pretty strong.
We got a bit jittery sometime in August when we had the filming. We saw that the Chinese economy was slowing down, and it was affecting various parts of the world, but we were pleasantly surprised to see that slowdown was short-lived, and as soon as I would say the August lull came to an end, the market started going again from strength to strength. So as we are approaching the winter months, we are seeing spot rates strengthening in all sectors, Right now we have a very strong Aframax market everywhere. The Caribbean, who lagged behind for a short period of time, is back in very, very strong returns, close to $30,000-$40,000 and above. The Suezmax market is also very strong, and actually we look very, very positively in the last 4 acquisitions that we timely made of very modern Suezmaxes that are contributing very strong to our bottom line. And I think the same is on the VLCCs and the product tanker market is strengthening. So overall, we are looking at a market that has good imminent spot prospects. But what is more encouraging for me is that we are seeing the clients, the people who actually buy and sell the oil long term, looking for covering their requirements for a long period of time.